And now the equities. The other 60% of our portfolio is going to be equities. The whole purpose of income investing is to build a collection of assets to provide a constant stream of cash for expenses during your retirement. As well as securities, it is good to keep a few months' cash on hand. Why is that? Cash gives you optionality and leverage. You know, it never can tell. Prices might go down. You might be able to get a bargain. Income investing used to be very popular before the great 20-year bull market taught everyone to be a growth investor, buying high and quickly selling higher. That's what I call the greater fool theory of investing. And it turns out usually that the greater fool is you. You think you're going to sell it to someone at a higher price, but often you bought too late. Well, this graph shows you a really big reason investors lose their money. This is the average holding time for New York Stock Exchange stocks. Look at this. Back in, I don't know, maybe 1938, 1940, people would keep their stocks for 10 years. Look at this now. It's going down. So that recently, the average holding time is 8 months. I don't understand that. We're going to talk a lot about compounding and compounding your interest and compounding your dividends, and that requires time. Excuse me. A couple of years ago, and it happens all the time, brokers say, well, you got to rotate out of this area and get into another area. And of course, what happens is that they make money on the commissions. You have to learn to be able to hold your stocks for a long period of time. That will allow compounding to work for you. I can understand now maybe why investors are scared to hold stocks for a long time. We've had 2 black swans in a short period of time. I figured out my average holding time a little while ago, and it's 12.5 years. If you're going to hold stocks for a long time, they better be good stocks. So selection process is very important. If we're going to hold these stocks for a long time, you want them to be good ones. I presume that most of you know what compounding is. It's the ability of an asset to generate earnings, which are then reinvested in order to generate their own earnings. And that's a really important aspect of individual investing. Now, this figure shows you that trading is hazardous to your wealth. If you look at the blue bars, that's the annual return that you're going to get from your portfolio. If you look at the red bars, that's the turnover. And you see that they are inversely related. The bigger the turnover you have, the smaller your annual return. That goes hand in glove with what we said about the last slide. Why do people trade so much? It's because they're so overconfident that they can beat the market and do a better job than other people. That shouldn't be much of a surprise if I tell you that trade is more apparent in men than it is in women. That's why women often make better investors than men, because they're not so overconfident about themselves. If you trade a lot, you're going to pay a tremendous performance penalty for active trading. Losing investors tend to tilt toward high beta, small value stocks with a high turnover. There is the illusion of validity. They think they're doing the right thing, but in fact they're not. We'll talk more about that later on. The same author, and you'll get these references when we send them out, analyzed instances in which an investor swapped one stock for another, expecting the new stock to do better than the old stock. You compare the returns of the 2 stocks over a course of 1 year. On average, the shares that individual traders sold did better than the ones that they bought by about 3.2% per year, which is a big number. That's above and beyond the significant cost of executing these 2 trades. The moral for you as an individual investor is buy good stocks and hold on to them for a long time. Income investing, and we talked about that briefly before. It's still practiced by a lot of wealth management firms, But they don't talk much about it because it doesn't generate many commissions for them. In income investing, what we do is put together a collection of assets to generate a high income at a low risk. High income, low risk. And this income is paid out to investors to use in their everyday lives, say during their retirement. Of course, you're going to pay taxes, but at a lower rate than earned income, since the income is mostly dividends. Depends on registered versus non-registered accounts. Now, income investing arose because women often outlived their husbands at this time. This was back in the early 1900s. But they were unable to replace them at work and to support the family. And it led to the infamous widow and orphan portfolios. These were put together to generate money so widows could manage to live comfortably after their husbands died. And widow and orphan funds, we're talking mainly about non-cyclical stocks with low volatility. This is a good choice for low-risk investment for retirement purposes. And this brings forth the concept of buy and hold. Buy and hold is terribly important. You need to buy these stocks and hold on to them at a long time. Okay, now we've talked about risk a bit, and I want to talk about that a little bit more. If you look at the on the right-hand side there, the old concept, you'll see that people thought that the more risk they took, the higher was going to be their returns. Well, I never thought that was right. It seemed to me the bigger the risk you took, the bigger the chance you had of losing money. So I drew this one on the left here. For me, the risk of investing is the risk of loss. So I'm concerned about losing money. So I found that you have much higher risk if you take up things like day trading, stock picking, mutual funds, small caps, growth stocks, high beta stocks. We'll talk more about those in a bit. You're much better off with low beta index funds, ETFs, being the TSX, blue chip dividend stocks, where you're going to get a higher return at a lower risk. You're often given the advice to crank up your risk when you're young, and I think that's incorrect. Losses at the beginning are much more detrimental. Here are some ways to reduce investment risk. Passive versus active. I don't have time to go into all this in great detail, but in your handout, you'll see this SPIVA paper. You can certainly get that from the web and take a look at it. It proves without a doubt that passive investment is better than active investment. Why is that? It helps you keep your emotions out of investment decisions. You keep your trading at a minimum. You want to give your investments time to grow, times to compound, and that's buy and hold. Another important factor is keeping costs at a minimum. You should try for less than 1%. And stock picking, of course, is not in our best interest. Making good financial decisions is very difficult for most people. We chronically buy high and sell low. Keeping your costs low are important because any potential gains can be negated by high fees. Here's one part of this SPIVA paper, and it stands for S&P indices versus active funds. Only 30% of actively managed Canadian equity funds outperform the TSX Composite Index over 5 years. Now, if you're starting out as an investor, do those odds sound attractive to you? The average fund, MER, that's management expense ratio is 2.4%. That's huge, especially when we're in a low growth period like we are now. Another thing that's important to know about these mutual funds is their turnover. They often turn over more than 100% of their stocks every year. This is a churning phenomenon, and of course, who pays for it? You, the investor, pays for it. Let's take a look at Canadian equity mutual funds versus the index. So you see, after 1 year, mutual funds doing pretty good. After 3 years, they're doing pretty good. But 5 years and then 10 years, the longer you go, the worse mutual funds perform. I think you have to be very careful before you consider purchasing mutual funds. Almost anything that you can get from a mutual fund, you can get from an ETF at much lower cost. And don't forget trailer funds and all these other charges that you are not expecting. So when all this churning and turnover, of course, buying and selling of securities is done mainly for the commissions. And as I said, turnover in most mutual funds approaches 100%. And now we're going to start talking about dividends. Investors often ignore dividends, but they're really important. They're beginning to get the dividend concept. With your income investing, there are 3 buckets you can put your money. Fixed income, dividend-paying stocks, and the third is real estate, or probably REITs. So you're going to get a dividend yield of maybe 4 to 6% from your dividend-paying stocks, and that's going to be really important going forward because you're not going to take those dividends out. You're going to leave them in there to accumulate and to grow over time. I'll give you a quote. The function of stocks is to earn income for investors by way of dividends. Anything else is mere speculation and risky as heck. Compounding is the answer for you in terms of your dividends. Well, let's go back and look at some historic data. This graph is for 139 years. It goes from 1871 to 2010. It's on a log scale, and it shows the plain return of the stocks versus the real return in growth, stock return with dividends reinvested. Look at the huge difference between the green line and the black line. It's about 500 times as much. Dividends account for most of the gain in stocks. Buy and hold is the way to get compounding working for you, and it is proportional to time. Well, we have 2 more graphs here. These are interesting because the one on the left is the S&P 500 nominal. That means that it doesn't include adjustment for inflation. It's a log scale. The effect of reinvesting the dividends are quite obvious. And it looks like a straight line, doesn't it? That's 60 years worth of data. But let's go to the second one. This is real. This is after we've taken inflation out, and it's a log graph. The effect of reinvesting the dividends is much greater. So at the top, the difference is between 140 and 65, where at the bottom, when you've removed inflation, the difference between 55 and 7, a much larger difference. And you can see that you start to see some paradigm shifts there. I put in some titles for what might have occurred: the end of World War II, Vietnam War, the computing age, the dot-com bust. I think there are long-term cycles, and it helps us to look at long-term effects in the market. Well, we've been talking now about the long term, 130 years, 60 years. Not many of us have that many years to invest. Let's just look at 10 years. This is 10 years of the TSX composite from April 10th, 2003 up to 2013. Look at the difference that compounding makes in terms of the total return. The difference is 58%. Your total return is 150% with compounding, only 95% with stock price increases. You'll see I've indicated a black swan there. That was this huge downdraft we had in 2008, 2009. You'll see how well the dividend stocks came back with the dividends. You see they made a new high, that blue line there. But so far, the composite really hasn't made a new high yet. Dividends are great, but compounding makes them better. Now, we look at this index. This is the TSX composite. You can't go and buy that. That's a non-investable index. You need to buy an ETF. Here's a quote that I like. A dividend is a dictate of management. A capital gain is a whim of the market. I suppose you know about ETFs. What you're paying there in terms of an MER might be somewhere between 0.5 and 1%. Just remember that you can't beat the index with an ETF. On the other hand, you're not going to have the big swings that you do with a mutual fund, and the MER is much lower. So let's look at the dividend as a percent of the real total return on equities. There's Canada and there's the United States. Canada, the total return for equities, 5.8%, and 75%, 76% of that came from dividends. The U.S. had a higher total return, but a lower return in terms of the dividends. So we get more dividends from Canadian stocks, and they are also tax advantaged. I should point out that Canada is the world's 6th largest stock market by capitalization, even though it's only 3% of the total of the world. And our bond market also ranks in the world's top 10. So Canadian markets are strong. Now, why should we buy Canadian dividend stocks? This dividend tax credit gives you about a 7% savings, and you don't get that if you buy U.S. stocks. These are annualized real returns on major asset classes from 1900 to 2013. So with Canada, you see our equities have averaged about 5.8%. And if you go back to that C.D. Howe report that we talked about at the beginning, they're predicting only 4.8% for the next decade. The bonds, Canadian bonds, have outperformed U.S. and world bonds, and so have our bills.